What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Wednesday, everybody. I hope you're all doing well. Today's episode is going to be very economics heavy. A few days ago, we had a very diplomatic and geopolitical heavy episodes. And so today we need to catch up on economic and financial developments. On Monday, at a special meeting of the State Council, often described as China's cabinet, PRC Premier Li Keqiang called for more economic support for a slowing economy. With poor economic data being published on an almost daily basis in recent weeks, it shouldn't be surprising that officials at the highest levels continue to ease regulatory and fiscal measures in an attempt to arrest the slowdown. According to state media, the Chinese premier, quote, urged efforts to gather wisdom from all sides to improve the government's work and specified measures to bolster China's industrial, economy, and service sectors. End quote. During the meeting, the State Council expressed that as the industrial economy is not yet fully recovered and some service sectors face difficulties due to COVID-19, a slew of measures will be rolled out swiftly, that's the word they use, to provide stronger support. According to the meeting readout, the country will step up income tax reductions and exemptions in the industrial and service sectors, prolong tax deferrals for small, medium, and micro-sized manufacturing firms, the crisis with these small firms we actually touched on a few days ago, and expand the scope of tax and fee cuts. For those of you looking for specifics, this year micro, small, and medium-sized enterprises that purchase new equipment worth above 5 million RMB, approximately $786,000 and with a 3-year depreciation period, are entitled to a one-off deduction of total purchase costs from taxable income, or a 50% deduction for such purchases of equipment with a depreciation period of 4, 5, or 10 years. Now, that may be too much in the weeds for some people, but I know there are some that watch this that need those details. Moving on, regarding the catering, retail, tourism, and transport sectors, which have all faced particular difficulties, the country will increase support for them in the form of tax reductions and deferred premium payments, according to the readout from the State Council. Analysts, including myself, are skeptical as to how effective these measures ultimately will be. Growth targets are still politically set, and thus moral hazard remains in place, misallocating resources and preventing rebalancing of the economy. These measures are also very supply side, and we know that demand side is one of the areas in which China is lacking the most in recent years, since the explosion of the pandemic in Wuhan. And of course, the Evergrande crisis is ongoing. After all, if Beijing is serious this time about forcing deleveraging in the housing sector, unless credit is pumped into infrastructure, which is the same problem with a different face, it's difficult to imagine the country avoiding a painful recession or substantial growth slowdown at the very least. And so this biting around the edges with these modest regulatory easings with tax on the supply side, I think are going to have limited effects. And this brings us on to the next question. With tax reductions and front-loading of infrastructure, which we've seen in recent months, the question is, where does the government get this money from? And this is what we've been asking for months now. Local government revenue is a topic we've touched on again and again on China Update. That is because it is an incredibly important space to follow. Local government income is where China's economic system and political power intersect. It dictates the relations between the center and the local, and between the people and the state. As we've discussed many times before, a major source of revenue for local governments is land right sales. In poorer regions, these auctions represent over 50% of total revenue for local governments, and in some regions, incredibly, it's as high as 90%. And local governments are pessimistic about the auction outlook for this year. We already discussed a few days ago, for example, that several provinces lowered their budget targets for land sales revenue, with Beijing, Shanghai, Zhejiang, and Qinghai in the center of the country all expecting declines of at least 10%. Anhui set a budget target of 3.9% growth, slower than the 13.2% growth it saw last year. And of course, according to consulting firm China Index Holdings, in 9 of 21 large Chinese cities that held land sales over the last 2 months of 2021, At least half of the plots were bought by local government financing vehicles, a sharp reversal of the previous private sector driven sales. Okay, next up, in recent weeks there has been a lot of attention from analysts and some in the media about the changing fortunes of players in the solar power industry in China, an industry of increasing importance globally and an industry that I think we need to follow. The once hot sector is now showing signs of cooling, as one financial outlet put it. So what is going on? Analysts with Caixin report this week that in December of 2021, a Zhejiang-based solar power facility provider, Hoymiles, Hoymiles Power Electronics Inc., raised about 5.6 billion RMB, about $880 million in its Shanghai Star Market listing, more than 10 times its target amount. According to its prospectus, the firm had planned to spend the proceeds on building power plants and upgrading equipment, so capital investment. But since its debut, the Caixin analysts point out, the company has, quote, announced plans to use as much as 4.5 billion RMB of the windfall to buy financial products, end quote. Hoymiles Power is not unique either. Since Beijing announced 2 years ago that China would reach peak emissions before the end of this decade, the solar industry in China has exploded, with capital from investors, international and domestic, pouring in. The China Securities Index PV Industry Index, which tracks the shares of 50 major listed domestic solar energy companies, jumped 45% last year, reaching a total market value of 2.8 trillion RMB. Solar energy firms Long-E Green Energy Technology Co. Limited, China Solar Limited, and JA Solar Technology Co. Limited, and others saw historically high valuations last year. However, it looks like many of these companies may have reached their zenith. In a recently published research note, CITIC Securities Co. Limited forecasts that the industry will see a serious downturn this year. After expanding 110% in 2021, the analysts predict conservatively that the industry will slow to less than 40% growth. The research note argues, quote, production capacity from the midstream of the industry on up has outrun output of its main raw material, polysilicon, causing price rises down the industrial chain and now leave the profitability of new solar power plants in question. Polysilicon is the raw material used to make silicon wafers, which are combined together into PV cells, which in turn are used to make solar panels. Anyone in this industry should be taking note. China's solar panels sector, therefore, will likely undergo a painful transition for the next 5 to 10 years after a few years of very lucky growth, as it is expected to soon experience excessive supply problems. And last up, China's Evergrande Housing Crisis. Lately, it seems that almost every day there is a new developer coming out of the woodwork that is experiencing difficulties and even at risk of collapse. By the way, guys, if you're enjoying the content, please remember to hit that like button. It's a huge help for a small channel. And if you're listening to this for the first time and you're getting some value from the episode, maybe consider subscribing. You'll have the most up-to-date analysis on China as I release it every day. Yet another property developer today is in trouble. This one is called Zhenro Properties Group Limited, Zhenro. This is the English name. Its Chinese name is Zhenro, but I'm going to use the English name since that's what most English-based commentaries are referring to it as, Zhenro. Zhenro is a mid-sized player, mid-sized player in China's real estate development sector. According to China Real Estate Information Corp, it was China's 30th largest builder by contracted sales last year. After concerns surfaced that the property developer would be unable to redeem a $200 million bond next month, the company's shares and dollar bonds collapsed. According to Bloomberg's business intelligence unit based in Hong Kong, their team of financial analysts, the 10.25% perpetual note in question plunged to 35 cents on the dollar from 93 cents the day before. An incredible drop, and some other dollar bonds were on pace for record lows after falling at least 10 cents, according to the analysts. Shares ended down a record 66% in trading the following day in Hong Kong. As we discussed yesterday with Wang Ke, with the Evergrande crisis, more and more developers are being sucked into downward spirals. The real estate market showed little sign of recovery at the beginning of this year, as the sales volume of the top 100 developers dropped 40% year on year in January after several consecutive months of decline. Highly leveraged property developers have seen their sales smashed and face very difficult financing environments. Total fundraising by developers plunged 70.3% year on year to 79.2 billion RMB last month. After all, the analysts with the intelligent unit with Bloomberg Hong Kong also argue that Zhenro's dollar bonds trading at around 40 cents indicate investors consider the company having a possibility of restructuring. Yesterday, Tuesday, bonds of Chinese property developers generally continued to fall, underscoring continuing investor pessimism in the sector. Yesterday, Zhenro's dollar bonds dropped even more, with a 7.1% September 2024 bond falling to less than 15 cents on the dollar. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.